When you look at shares of Nissan, this is a stock that's under pressure. They have issues in terms of really overproduction and now steep discounting in several key markets around the world, including in the United States.
Right now, at this exact moment, there are 80,000 Nissan vehicles sitting at US ports, not being driven, not being sold, just sitting. The Versa, the Sentra, the Kicks, the Rogue. Parked in rows that stretch further than you can see, and dealerships are refusing to take them. That's not a supply chain problem. That's not a shipping delay. That is a demand collapse happening in slow motion, and the people running Nissan know exactly how bad it is. Here's what they don't want you to figure out. When a company is drowning in 80,000 unsold cars and staring down a $5.6 billion debt bill due this year and cutting 9,000 jobs to stay alive, something has to break. And when it breaks, the buyer who saw it coming gets the deal of the decade. But here's the question nobody is asking. Is Nissan offering you a discount right now? Or is it quietly selling you a car from a brand that might not look the same 2 years from now? Right now, there are 80,000 Nissan vehicles sitting at ports and storage lots across the United States, not in transit, not being prepped for delivery, just sitting there, taking up space, costing money every single day they don't move. To understand how extraordinary that number is, you need to understand what normal looks like. In a healthy market, a manufacturer maintains roughly 60 days of supply on dealer lots. That's the industry benchmark. That's the number that keeps production lines running, dealers profitable, and prices stable. Nissan right now is sitting at over 100 days of supply on several of its core models. That's not a warning sign. That's the alarm already going off. But here's the detail that tells the real story. These cars aren't just sitting on dealer lots waiting for the right buyer to walk in. Dealers are refusing to take delivery. The vehicles are staged at ports and off-site storage facilities because the dealerships themselves don't want them. When a dealer, whose entire business model depends on having inventory to sell, looks at a shipment of new Nissans and says, "No thank you," that is not a routine inventory adjustment. That is a vote of no confidence. Think about what that means in physical terms. 80,000 vehicles. If you lined them up bumper to bumper, they would stretch for roughly 300 miles. That is a line of unsold cars running from Los Angeles to Las Vegas with room to spare. Every single one of them representing a unit that Nissan built, shipped, and cannot move. And every single day those cars sit, Nissan is paying storage fees, depreciation, interest on the capital tied up in that inventory. The meter is running, and the exits are narrowing. This is not a supply chain story. Supply chain problems mean you cannot get enough product to meet demand. This is the opposite. Nissan has the product. The market simply does not want it badly enough at the prices Nissan needs to charge. That distinction matters enormously, because it tells you exactly what has to happen next. Nissan didn't arrive at 80,000 unsold cars by accident. This took years of decisions that made sense on paper and collapsed in practice. Start with China. For decades, China was Nissan's crown jewel, the world's largest car market, and Nissan had cracked it. Volume, brand recognition, dealer networks, Nissan built something real there. Then Chinese electric vehicle brands arrived, backed by government money, priced at levels no Japanese manufacturer could match, and technically competitive in ways that caught the entire industry off guard. Nissan's sales in China dropped nearly 15% in a single fiscal year. That's not a DIP. That's a structural loss. And there is no quick fix for losing ground in the world's largest car market to competitors who are getting cheaper and better every single year. Then look at America. The US market didn't punish Nissan for one big mistake. It punished Nissan for years of smaller ones. The lineup got stale. Models that were competitive in 2018 were being compared against sharper, fresher rivals by 2023, with no meaningful updates to justify the price tags. Dealers started piling on incentives and advertising spend just to move units off the lot. The product wasn't pulling its weight. The hybrid miscalculation made everything worse. While Toyota was printing money with the RAV4 hybrid and Honda was selling every Accord hybrid it could build, Nissan made a strategic bet that the market would skip hybrids and move straight to full electric. That bet is now visibly, painfully wrong. The hybrid segment is growing faster than pure electric. Nissan has almost nothing to offer in that lane right now. And the Ariya, Nissan's flagship electric vehicle and the car meant to signal its future, doesn't even qualify for the federal $7,500 tax credit because it's manufactured in Japan. In a market where that credit is often the difference between a sale and a walkaway, that is not a minor footnote. The result of all of it is a brand that is losing on every front simultaneously. And the 80,000 cars sitting at US ports are the physical evidence. The unsold inventory is the problem you can see. The $5.6 billion debt is the problem that could actually finish Nissan off. Here is how the numbers break down. In 2025, Nissan owes approximately $1.6 billion in debt repayments. That number is uncomfortable but manageable given the cash reserves the company claims to hold. In 2026, that number jumps to $5.6 billion. That is not a gradual increase. That is a cliff. And Nissan is running toward it with declining sales, collapsing profits, and an inventory crisis bleeding cash every single day. The bonds are structured across multiple currencies, yen, dollars, and euros, which adds another layer of exposure. As the yen fluctuates and global borrowing costs stay elevated, the actual cost of servicing that debt shifts in ways Nissan cannot fully control. They borrowed in a different rate environment. They are paying it back in this one. The credit rating situation is where it gets genuinely dangerous. Moody's currently rates Nissan at BA3. Fitch has them at BBB. Those are the lowest possible investment grade ratings. One downgrade from either agency and Nissan falls into junk territory. S&P has already placed them at BB+, which is junk right now. That is not a technicality. A junk rating means institutional investors who are only permitted to hold investment-grade securities are forced to sell. It means borrowing costs spike. It means refinancing that $5.6 billion becomes dramatically more expensive at exactly the moment Nissan can least afford it. The market is already pricing in that risk. Default insurance costs on Nissan debt have been rising steadily. Bond yields are climbing. These are not predictions. They are real money moving in real time based on what sophisticated investors believe is likely to happen. Nissan publicly points to $8.3 billion in net cash for its auto division and access to $12.3 billion in credit lines as proof it can handle the load. And maybe it can. But analysts are watching those numbers shrink quarter by quarter while the debt wall stays exactly the same size. The clock is running. The math is unforgiving. When a company cuts 9,000 jobs, it is not making a routine adjustment. It is admitting that the structure it built cannot survive in its current form. Nissan announced plans to eliminate 9,000 positions and reduce production capacity by 20%. The company projects these moves will save approximately $2.6 billion. Read that number carefully. They need to cut $2.6 billion worth of human beings and factory output just to stabilize the bleeding. That is not a company trimming fat. That is a company cutting into muscle because the alternative is worse. The factories affected have not all been publicly identified. That uncertainty is its own problem. Workers in plants across Japan, Mexico, and elsewhere are showing up every day, not knowing if their facility is on the list. That kind of uncertainty destroys productivity, accelerates voluntary departures of skilled workers, and damages the institutional knowledge that took decades to build. You cannot cut your way to innovation. You can only cut your way to survival, and only if the cuts are deep enough and fast enough to matter. Nissan is also selling 10% of its stake in Mitsubishi, reducing its ownership from 34% to around 24%. That is a company liquidating assets to raise cash. When you start selling pieces of your portfolio to cover operating losses, you are not executing a strategy. You are managing a retreat. Here is what the production cut tells you as a buyer. When Nissan reduces output by 20%, the pipeline of new vehicles entering the market tightens over the next 12 to 18 months. That means the current inventory glut, those 80,000 cars sitting at ports right now, represents peak supply. The discount window is open now. Once that inventory clears and reduced production catches up with demand, the leverage shifts back toward the dealer. Before we go any further, if you are shopping for a car in 2026, you need to know which models to avoid entirely. Download my free ebook, Avoid These 17 Cars, in 2026. It is free, and the link is in the description. The cuts are real, the timeline is urgent, and the pressure is about to land somewhere specific. Nissan's problems didn't need any help getting worse. Then trade policy walked in and made everything harder. Nissan operates 5 major manufacturing plants in Mexico. Those facilities produce some of the most important models in Nissan's American lineup: the Versa, the Sentra, and the Kicks. These are not peripheral models. These are the affordable, high-volume vehicles that cost-conscious American buyers actually purchase. They are the cars sitting in those port lots right now. And they are the cars most exposed to what is coming next. The proposed tariff structure targeting vehicles produced in Mexico includes figures as high as 200% on certain categories. The stated purpose was to prevent Chinese electric vehicle manufacturers from using Mexico as a backdoor into the American market, building plants south of the border and shipping finished vehicles north under USMCA trade protections. That is a legitimate policy concern. But the way the tariffs are structured, Nissan gets caught in the crossfire. A Japanese manufacturer that built its American supply chain around Mexican production over decades is now facing the same tariff exposure as the Chinese competitors the policy was designed to stop. Do the math on what a significant tariff does to a Versa. That car's entire value proposition is affordability. It competes at the bottom of the market on price. Add thousands of dollars in tariff-driven cost increases, and the Versa either becomes uncompetitive on price, or Nissan absorbs the margin hit on a model that was already barely profitable. Neither option is good. The Ariya situation adds a layer of bitter irony. Nissan's flagship electric vehicle is manufactured in Japan, which means it was already excluded from the federal $7,500 EV tax credit. Under a policy environment that is pulling back EV incentives broadly, the Ariya paradoxically becomes slightly more competitive because its rivals lose their credit advantage. But that is a thin consolation for a brand that bet heavily on electric and is now watching the regulatory environment shift against the entire category. Toyota saw this coming. Honda saw this coming. Nissan was looking the wrong direction. Everything you just learned about Nissan's crisis translates directly into negotiating power if you know how to use it. Here is the fundamental rule of dealer economics. When inventory sits, dealers negotiate. Not occasionally, not reluctantly. Always. A car that has been on a lot or staged at a port for 90 days is not an asset anymore. It is a liability. Every day it doesn't sell, the dealer pays floor plan interest on it. Every day it doesn't sell, it depreciates. Every day it doesn't sell, it represents capital that cannot be deployed elsewhere. Dealers are not sentimental about metal. They want it gone. Nissan's current days supply numbers on models like the Versa, Sentra, Kicks, Rogue, and Pathfinder are sitting well above the 60-day healthy benchmark. Some models are pushing past 100 days. That gap between healthy and actual is your leverage. Walk into a Nissan dealership right now, understanding that the person across the desk needs that car off the lot more urgently than you need to drive it home today. What that means practically is below invoice negotiations are realistic right now. Significant cashback offers are already appearing on multiple Nissan models. Dealer incentive stacking, combining manufacturer rebates with dealer discounts and financing incentives, is absolutely in play on slow-moving units. These are not deals you have to manufacture. They are deals the market is already creating because the inventory pressure is that severe. The timing matters enormously. This window exists because of a specific collision of circumstances: the inventory glut, the debt pressure, the production cuts, the tariff uncertainty. That collision is happening right now in the spring and early summer of 2026. Once Nissan's production cuts take effect and the pipeline of new vehicles tightens, the supply dynamic shifts. Fewer cars mean less dealer desperation and less negotiating leverage for you. But go in with your eyes open. Buying from a brand under this kind of financial stress carries real risk. Resale values on distressed brands compress. Dealer networks contract. Parts support and warranty backing become legitimate questions worth asking before you sign anything. The discount is real, so is the fine print. Nissan knows exactly how bad the situation is. The question is whether what they are planning is enough to fix it in time. The official survival plan centers on 7 new hybrid and electric models, promised by 2028. That is the headline commitment. That is what Nissan is asking investors, dealers, and customers to believe in. And on paper, it sounds like a response proportional to the problem. Hybrids are what the market wants. Nissan is promising hybrids. Case closed. Except the timeline is the problem. Toyota is not waiting until 2028. Honda is not waiting until 2028. Every quarter that Nissan spends without a competitive hybrid in showrooms is another quarter where loyal Nissan customers walk into a Toyota dealership, drive a RAV4 hybrid, and never come back. Brand loyalty is not a permanent condition. It is a window. And Nissan's window is closing faster than a 2028 product launch can address. The China situation is even harder to solve. The Chinese EV brands that displace Nissan in that market are not standing still. They are getting cheaper, better, and more aggressive every single year. Nissan would need a fundamental reinvention of its cost structure and product strategy to reclaim meaningful ground in China. There is no realistic path back in the near term. That market may simply be structural lost for Nissan at the volume levels it once enjoyed. Nissan has survived near death before. The Renault alliance in 1999 pulled the company back from the edge of bankruptcy when it was carrying debt that looked unsurvivable. Carlos Ghosn walked in, cut ruthlessly, and rebuilt the product lineup with enough force to make Nissan relevant again. That turnaround is studied in business schools because it was genuinely remarkable. But that was a different era. The market moved slower. The competition was less brutal. The technology transitions were less disruptive. Surviving 2026 requires moving faster than Nissan has shown it can move. The margin for error is almost gone. The next 18 months will determine whether Nissan is a turnaround story or a cautionary tale, and right now it could go either way. Go back to that image for a moment. 80,000 Nissan vehicles sitting at US ports right now. Rows and rows of Versas, Sentras, Kicks, and Rogues that dealers don't want, that buyers haven't chosen, that are bleeding money for a company already running out of room to maneuver. That image is not just a story about Nissan. It is a lesson about how information works in the car market. Nissan knows those cars are sitting there. The dealers know. The auction houses know. The analysts tracking days' supply numbers know. The only person who doesn't automatically know is the buyer walking onto a lot this weekend with no context, no leverage, and no understanding of the pressure sitting on the other side of that negotiation. Now you know. And that changes everything about how you should approach a Nissan purchase in 2026. The inventory is real. The dealer pressure is real. The discount window is open right now in a way that it will not be forever. Production cuts are already in motion. Tariff uncertainty is already repricing the supply chain. The specific combination of circumstances creating this leverage for buyers is a temporary condition, not a permanent one. But knowledge works in both directions. The same information that tells you discounts are available right now also tells you that buying a distressed brand carries risks that a healthy brand doesn't. Resale value, dealer network stability, long-term parts, and service support. These are real questions that deserve real answers before you commit. The wave of consequences. From Nissan's strategic mistakes is still moving. It has not finished reshaping the market. The buyers who understand that will make decisions that protect them. The buyers who don't will pay today's emotion and discover tomorrow's reality. The informed buyer doesn't just get a better deal. The informed buyer avoids the deals that feel good in the moment and cost them later. Download my free ebook, Avoid These 17 Cars, in 2026 before you step foot on a lot. The link is in the description. It is free, and right now, it matters.